If your supply chain runs through Asia, why not work with a company that has been connecting Asia with the world since 1971? Dimerco Express Group. Hello and welcome to the Freight Buyers Club. I'm Mike King, and before we get going, you've just seen a little message there from Dimerco Express Group. They are supporting today's episode. Think of them as your go-to for the Trans-Pacific trade lanes, Asia logistics headaches, and the kind of tariff and compliance issues that tend to ruin everyone's day at 4:55 p.m. on a Friday. Or maybe over the last year and a half, maybe on a Sunday night. You know what I mean. Now, the first quarter of 2026 was, by more or less any measure, one of the most disrupted openings to a year that container shipping has seen in living memory. The US Supreme Court struck down Trump's IEEPA tariffs in February. The Strait of Hormuz was then closed. War broke out in the Middle East. We've now got Iranian ports blocked, fuel surcharges popping up everywhere, and Cape of Good Hope sailing still the default for east-west trade more than 2.5 years after the Red Sea was effectively shut for container shipping. But underneath all the shouting and the chaos and the madness, there are some pretty significant structural shifts in how container trade is conducted, emerging. And to unpack what's actually happening in those numbers, I'm delighted to say I'm joined today by Nigel Pusey, CEO of Container Trade Statistics, or CTS, the most comprehensive container data set out there. Nigel, welcome to the podcast.
Good to join you, Mike.
For listeners who don't know CTS, can you just give us a quick overview? What's in the data set? What's the reporting cycle? How should listeners maybe think about your numbers versus the freight index providers?
So yes, Mike. So CTS provides two data items. One is the global volumes of TEUs broken down to affected lowest level port, but it can be summarized country and regions. And we get the data directly from the manifests of the big shipping lines. We take about 75% direct from the lines, and the rest we estimate from the vessel sizes, etc., or other commodity data supplies. So we basically try and have 100% of the global data. The second thing we have is a price index, and that price index is unique in that it comes from the invoices generated by the shipping lines. We don't estimate anything on that. So what we could do is record how invoices have happened historically. And our biggest difference with other freight indexes, we're a historical record of how freight has moved as opposed to a predictor of what might happen in the future. And so however you want to use an index, that this index has good historical value, not very good for necessarily predicting the future, but good to recognize what happened in the past.
Excellent, Nigel. Just a bit on your background as well, if we can. You spent most of your career on the carrier side, Maersk,
Indeed.
Copenhagen,
Yep.
P&O before that.
Yeah.
Just how does that extensive experience shape how you read the data or translate it for people like me?
So I think I had my slightly unique, I suppose, experience is that I'm an accountant by profession. So when I started, I spent my life analysing the manifests and the bills. My job now is the other way around. I'm doing it on a data basis rather than a financial basis. But in between, I was Chief Commercial Officer at P&O Ned Lloyd and with Maersk Line through the mergers. So I have a benefit of sort of understanding the numbers, been able to unpack them in terms of the commercial trade and understanding that we have from having been on both sides of the fence.
You're going to be a great guide today, Nigel. I'm delighted to have you on. Before we I wish I had some accountancy experience myself going through some of these numbers. We're going to show people and talk through a lot of them today.
Yeah.
Before we get into the specific trades, let's set the scene with the headline numbers. Q1 global container volumes. What happened?
Yeah, so basically we're sitting with a very rosy first quarter number of a 47.2 million, which is up pretty much a 2 million on this time last year, which is 4 million up on 2 years ago. So some pretty robust first quarter growth we've been seeing. It represents about 4.4%, but we'll go back to this later. But that would have been closer to 6 if the Middle East and the Hormuz impact in March hadn't taken place, and it was similar volumes to last year. So some pretty robust growth still going on, and it reflects pretty much what we've seen in 25 and pretty much 24 as well. So it's largely a continuation of that trend.
So basically, despite all the disruptions, I mean, there's nothing to be surprised of here. You're saying
No,
this is just ongoing growth.
yeah, I think it's ongoing growth. I think we might have been a little bit surprised in one or two areas, but I think the underlying trend, we were expecting something of this growth for the first quarter. It's the offsets are what we didn't expect, if you see what I mean. If it had been 6, then that would have been a bit too robust. But on the other hand, Far East imports to Europe have been much stronger than we'd anticipated.
Yeah, well, I think a lot of people will be surprised by those numbers.
Yeah.
On pricing, your global price index was sitting at 79 points at the end of Q1,
Yeah.
back to around the same level at the end of December last year. But there's been a lot of variation by trade, which sort of is masked by the overall number. But first, Nigel, can you explain the CTS index base year is 2008, right? That's 100 points. What does that mean for people, for what people are paying in Q1, and maybe what they're paying now?
Yeah, so basically the way it works is the index was set, whatever the freight rate, average freight rate, let's say we take Far East to Europe trade, it basically says what was the average freight rate in 2008. And then what we effectively do have measured the movement in that freight rate over that period for the last 16 years. But the real key for people who use the index is how has the index moved on an individual trade basis or a global basis from one month to the next? So the percentage increase is the key. What's actually been happening month on month? So the index just measures the movement in those invoices. So, we get 99.5% of every invoice on the Far East Europe trade. So we know that if the freight rate has gone down, that's because there has been a reduction in overall invoicing in that period.
Okay, fantastic. I don't know. I was thinking we've got this picture overall globally of, I would say, sort of resilience on top, but a lot of volatility, which I want to pull apart a little bit, starting with the demand picture across the two main head haul trades. And for those watching on YouTube or Spotify, this is the chart I want to spend a bit of time on because I think it tells the most interesting structural story. And a quick shout out to Karen Ball in production and Florence Taylor at CTS for making these numbers and images happen. What those who are watching now can see is the two big head haul trades from the Far East each month over the last 2 years or so. First up, you can see the Far East to Europe trade month by month volumes. It's all very seasonal, as shipping always is, but you can see this general upward trend if we draw a line between January 2024 and January this year, for example. Now, what those watching can also see is the Far East North America volumes month by month over the same period into 2026. Again, very seasonal. But if we draw the same line, you can see a very different, far less dynamic trend. Now, anyone who watches the Freight Buyers Club regularly, you probably know at least one major reason why we are seeing these different volume growth stories. And it starts with a T and ends with FFS. And that's not the rude version of FFS. So I think you know what I mean. So Nigel,
Yeah.
the two head haul trades, very different volume growth trajectories over the last 2 years. What are you seeing in these numbers?
I think, ultimately, I think the tariffs have driven a thought process in all of those. That in effect, it's driven different ways of thinking about how to move freight. And in reality, the tariffs have changed China's view of how it was going to deal with America. We'll see that in the numbers. You've seen dramatic, last year, overall Far East volumes to North America down 4%, and they've been 15% up the previous year, whereas Far East to Europe were 9% up in both years. So you've got that massive switch during last year. It was tariff driven, but it started much earlier to get countries. China's thinking was, we're tariffs is going to disrupt trade, where do we move the cargo to? And I think when you start unpacking that, you start to understand that this is a more deeper economic shift aligned to, well, if you're going to muck around with tariffs, we're going to find more stable places to move cargo to. And, we're going to adapt our business strategy around that. You won't be playing ball with us. And therefore we need to find different ways of moving cargo to markets that matter to us. So I think there's a sort of deeper understanding about movement of trade that's going on here. The question is, will it ever rebound? Will it come back? Interesting thing to unpack.
We are going to be looking at where some of that Chinese cargo is going, and we'll look also at who else is now sending stuff to the US, because there's some winners out there. But first, just on the US decline,
Yeah.
how much of you do you put it down to tariffs and policy versus consumer demand softness, or do we need to wait till later to get into those numbers?
I think it's easier when you start looking at some of the things. There is definitely a softening. I think tariffs has had an impact on customer international demand. The difficult bit is unpacking in America whether the softness in demand has been caused by a lack of imports or whether it's just a lack of general consumer confidence. And there's been a lot of money pumped into the American economy, so you wouldn't think the demand was slow. So it suggests that people are turning away a little bit from imports and finding other sources broadly internally where they can. But the resilience in the trade, overall North American imports are down 4% from anywhere in the world. So that suggests that people are just not bringing cargo into the States. And people are not even attempting to try because of the complexity of tariffs, etc. So it's as much people turning away from the States as it is the States not wanting to import it, I believe.
Interesting. Yeah, some of this doesn't match up with economic indicators that a lot of people will be familiar with. I get the PMIs for Europe and the US, and
Yeah.
they are very different pictures. They definitely don't shine a great light on Europe. But on the Europe side,
Yeah.
what we're seeing there, do you see this as real end demand given some of these bearish economic forecasts, or is this stockpiling, or is it people pulling forward cargo and then it just looks like strong growth?
So I actually think this is when we've gone down and had a look and drilled down and look in the data, I think there are all three of those are happening. So let's start with the top one. There is some growth out there. There are some countries that have seen some massive growth. If you go and look at somewhere like Poland, their 25 over 24 volumes are up 22% last year. So that is big growth. You're seeing it in North Africa. We're seeing quite massive increases. We're seeing it in the Levant as well. And the East Med, North Africa, Poland's, Romania's, Bucharest countries, they're also picking up some significant volumes. So we are seeing that. Now, that clearly wouldn't sustain a 15% growth in the first quarter. So I'm pretty confident that what people are doing is pulling cargo through. I think the 15% in Q1 is a slightly unusual number because it also reflects the fact that Q1 25 was the reorganization of the alliances. And I think there was a softening during the alliance when people were going to, the Gemini was being set up. You got the reorganization. There was a hesitant.
So this is Gemini. This is Maersk and Hapag formed the Gemini cooperation.
Yeah.
So they were reorganizing their network in the first part of 2025.
Correct.
At the same time as MSC is also reorganizing
Exactly.
its standalone network, right?
Yeah. So I think there was a reduction in cargo in that period where customers were just a little bit hesitant. They pulled a lot forward into December 24, January 25. So I think it's going to take a little bit longer, but that doesn't mean that hasn't been a pulling forward of cargo. If people are stockpiling, they've been doing it for a long while because we've had 9% growth in Europe last year. We had 9% growth out of Far East in 24 as well. So there is a demand underlying. There's a stockpiling. I think particularly Q1, if there's something else going on, it is we got caught in another world crisis during COVID. We're not going to allow our supply chains to be underfunded. And I think there's a lot of caution going on there to make sure that they've got sufficient in the supply chain to deal with any crisis that might happen.
I'm fascinated to hear what you think about whether this is peak season on the Far East Europe trade or not. But also same on the US when that's going to happen. We'll come back to that.
Yeah.
I just want to first drill into the US specifically, because the headline number on Far East to US doesn't really tell the whole story. Inside that, as we've referenced already, there's this major shift in origin. What you can see on screen now is first Greater China to USA monthly volumes. And now we have the Southeast Asia to USA volumes. It's a very different flow, Nigel. Tell us what's going on in terms of this change in origin share.
So basically, you've seen Great China last year down effectively 10% year on year. So that is an equivalent of 1.8 million TEUs in a year. That's a massive number of boxes not going into the US. Southeast Asia is up around 1 million TEUs. So you've got a net loss, which reflects that 4%, and that's pretty much continued into the Q1 numbers. So you've got this displacement out of China. That's 10% is significant, but it's being picked up quite substantially in Southeast Asia. And what we're finding is that this is a structural shift, possibly from Chinese companies going into Southeast Asia, and we can unpack those countries a bit later. But we are seeing something which is saying, yep, well, we can't source it from China. It's much more certain to keep it in the Vietnam or Cambodia or whatever. And are those Chinese companies, or is it being selected from non-Chinese companies? I suspect it's largely the former. So it's the China choosing.
There's a fair amount of evidence to say it is, and it also applies a little bit to Mexico too.
Yeah. So what we're seeing is that shift is starting to become, let's say, embedded, because there's going to come a time where the investment to make that worth just needs to keep going. So my feeling is that is going to start to happen. I don't think we're going to get much lower than where we are now. I think we've probably reached. There seems to be an impasse on the tariffs that's going to keep this at this level. There are some goods that will always go from China, but with the structural change is very significant. And the net effect is 800,000 boxes not going into America on an annual basis. And we'll probably see a similar number this year.
So it's not a one-to-one replacement from China to Southeast Asia. It's just volumes in general have dropped. But so when you say it's embedded, what happens, say, for example, if tariff policy, which has been one of the drivers of this, I don't just mean in this administration. I think some of these processes were in place from the first Trump administration as well, and maybe before that. So is it embedded, but could there be a change in US policy that would reverse any of this?
I think if it goes on, if we're looking for another 2.5 years of a Trump presidency, I can't see that changing. I think that's going to be there. And once you get to the end of a 3-year shift, you've embedded what is a pattern, and why change it when it changes? It's a lot to do. I see it a little bit in what's happened around the Cape of Good Hope. We're 2.5 years, as you said earlier, into that shift, and you're starting to find that people are actually quite liking that, arrangement. They've got their supply chains organized around it. Switching to Suez could be more of a crisis than just continuing. So I think here we've also got something where there's an embedded nature of it continuing for a period of time. Who knows? But for this, I think it's
3 presidencies in terms of trade policy.
Exactly.
Really, there hasn't been that much divergence.
No, exactly. So I think this is pretty much going to keep going, and we'll see. It won't grow at quite the level. I think we've had the one-time shift, but I think we're going to see this continuing and a slow trickle out of China into these other countries.
Okay, the big one then, Nigel. We trailed this earlier. Inside Southeast Asia, who's winning? Vietnam, Thailand, Indonesia, Singapore, Malaysia. I could name them all, but I'll let you analyze it instead.
Well, just to give you a feel, 50% of it is Vietnam. So Vietnam is the big winner, because that's taken pretty much half of the increase in Southeast Asia over that period. Thailand in sort of second place with about a third of it. And then Cambodia with 10 to 15%. And then smatterings, the Philippines, Malaysia, some of the other countries, relatively small increases. But, that's where the big drive has been. Vietnam and Thailand pretty much taking over 60, 70% of the total increase.
Just on the US import volumes for the second half of 2026, I mean, we're moving into peak season or traditional peak season territory. The Transpac contracting season's coming into an end, although exactly for how many companies we're not entirely sure, because some people were certainly delaying finalizing those
Well,
contracts, so there's so much uncertainty. Where do you think that trans-Pacific volume will end up this year? When do you see peak season happening? Will we have one?
my personal view is there won't be much of a peak season this year. I think, with everything going on, it's going to be fairly flat. I don't think we're going to see the reductions that we saw last year, but we're not going to see any improvement this year. I think we're going to have a small couple of percentage points softening compared with last year. The full impacts of the tariffs probably didn't really take place until beyond Q1, but the main drops were in beyond Q1 last year. So I think we'll still see a bit of a drop, but it's not going to be very significant. And we might see an improvement in Southeast Asian volumes as people see the attraction of doing that type of exports.
Nigel, so the no peak season on the Transpac, Asia, Europe, how are you seeing that? I mean, we've discussed it already. There's this pull forward, early loading, possibly. I mean, obviously things take a bit longer to get to Europe now, so I guess that's a factor. But could we still see a pickup in traffic in Q3?
I think it's not likely, actually. I think but there is so much volume passed through in the first quarter. And the demand softening has to come. GDP, European GDP is 1.5–2%. It is not supporting a 9% year-on-year increase. So despite my point about big other countries that are picking up in demand, I just don't think that's a sustainable number going into the end of 26. Sorry, I think we must recognize that we're going to get a softening, and it'll be a dampened peak season if at best this year.
Just on the origin mix into Europe as well, Nigel, obviously slightly different trade policy. Well, for now at least. Are we seeing any shift from China to Southeast Asia for where Europe's buying its cargo, or is this still very much China dominated?
It's very much China dominated. And, if you look at it from, it's still, the growth out of China is still well over 12, 13, so the whole overall percentage last year was 9, but the growth was all out of China. It's almost 12, 13% last year out of China into the whole of Europe, and to the likes of East Med, you're closer to 20%. So it's a very strong growth. It's all China driven. Southeast Asia has a small and complete contrast to the US situation. So they're very much continuing the China drive, so to speak.
Could you see that changing if Europe's trade policy changed?
I think if it did change dramatically in any way to the same degree, it could. But I think Europe's probably much more akin to what China's doing in terms of overall imports. I think it would be a very difficult shift for the European economies to achieve that.
The reason I asked for the trade policy is because I'm sure we're not alone in looking at some of these numbers about European exports and being slightly worried about this trading relationship. And people can see something on screen here. You're showing that in March, only 34% of available capacity on Europe to Far East was actually being used for cargo. So a lot of empties, a lot of empty slots. Wow. 2/3 of the boxes are going back east empty, or however you want to look at that. Big numbers.
And I think that actually reflects the challenge of the global networks at the moment, in that it's probably easier to take an empty back than trying to sell an export. So, we've seen this widening gap for two reasons. One is the velocity of containers around the network has slowed because of these stretch networks, like going around the Cape of Good Hope. It takes longer to get the empties back. I think that the decisions here are very much an operational one. We make the return on the import box, probably cheaper for us as a line to get the empty box back rather than to necessarily price into cargo that you might be making a loss on. The economics of an individual box probably is better to fill it with cargo. The challenge is when you look at the network price of that, is that wise if you're having to leave that box for another 2 weeks in China, where you could turn it round and fill it with relatively high paying cargo?
So you think that's happening quite a lot? We saw this during COVID, especially in the US. There's a big kickback against it.
Yeah, absolutely. And I think we will find that this will get worse for a little while longer. I think the imports probably will soften off a little bit in the rest of the year. But, at 3.5 times for every one box coming in, every one box going out of Europe, 3.5 are coming in. That's a massive turnaround of boxes that you've got to keep doing to feed that import drive.
That brings us onto this chart, Nigel. Probably one of the most important out there for me, at least. Anyway, I remember you showing this at TPM, and I was quite shocked myself.
Yeah.
This is the Far East Europe head haul back haul ratio, as you just mentioned there. 2.4 to 1 in 2023, 3.5 to 1 in 2026, a 45.8% increase in the imbalance in 3 years. What's going on? I mean, is this the collapse of European manufacturing? This is why I was referencing trade policy and what might change there in the future and how that might affect Southeast Asia, because that's unsustainable to me economically.
Yeah, I think one of the big challenges we've seen quite a big drop in German exports in the last 2 years. I think that at the core, obviously imports are increasing, but we've seen quite a dramatic decrease in German exports across the region in the Far East. And I think that has had this import of dragging exports down and effectively being filled with import cargo. There may be the same product, but just coming back in as an import rather than as an internal transfer within Europe. And at the same time, Germany stopped taking the machinery that it used to move out to China for building the factories that are now manufacturing what they had previously done themselves. So that sends with number. I think I was looking at the number, but Germany have lost 250,000 exports TEUs over the last 2 or 3 years. So it's quite a significant reduction.
Some of this, though, I mean, there are one-off shipments, but also it strikes me that this sort of ties in with when electricity prices across Europe got more expensive.
Yeah.
This is just coming in. This is 2023 as things start to accelerate in terms of that imbalance, and this is just after the 2022 war started in Ukraine,
Yeah.
and we had sanctions on Russia. Do you see a link to that, or is this more like Asian mercantilism? I'm putting you on the spot slightly there.
I think it's more Asian mercantilism, actually. I think that the entrepreneurial spirit of saying, well, look, we can take what Europe's done and we can produce it cheaper. We've seen it in automotive industry. We're seeing massive import into certain countries of Chinese vehicles. Some of that's coming by container, some of it's coming by car carrier, but it is a massive increase. And those were historically machines that were, sent out by European manufacturers to manufacture in China for their vehicles. Now it's Chinese manufacturers doing it themselves. So that's a classic market where we've seen the reversal of the Asian companies making sure that they can produce it using similar machines, but at a fraction of the cost that European manufacturers can do.
Thanks, Nigel. That ties in very well because we've got Chad Bown, who's the co-authored How to Win a Trade War, coming on the Freight Buyers Club in the next few weeks, I hope. So we'll explore how that might play out in terms of trade policy, not just for Europe, but globally, and this increasingly fragmented world, and what it all means for you guys who are moving cargo and just trying to get on with your lives and your businesses. Just going back to this imbalance, Nigel, what does it mean for carriers? I mean, you've already said about the economics of shipping empties back east. What does a change in that imbalance look like for the carriers, or for what would need to happen for the economy?
Well, I think the challenge will be, have you got enough boxes? I mean, one of the benefits, I suppose, from the carriers' side is they bought an awful lot of their own containers during COVID. The profit margins that they made allowed them to buy a larger percentage of their own boxes, and I think that may well continue because the more control you've got your own boxes, the least cost of hiring a box because you've got a shortage. You're controlling your own asset. So I think this will continue. I think we will see the lines needing to be clever about how they manage imbalance. It's probably their one big sunk, cost that they have to constantly move boxes around. But I think, for them it's about making sure that you've got a constant supply in your major demand points, and China, making sure that we see China just being filled with boxes for anywhere. It doesn't just have to come back from Europe, remember. We saw Transpac rates tightening about 18 months ago when Greater China, there was no demand in Transpac, but what we were seeing was there was a shortage of boxes, basically because it was now being stretched around the Cape of Good Hope. And I think that process will continue, and we're still going to have to find that we need a lot more boxes to fulfill the total global throughput than we did in the past. I don't know what the numbers are today, but we used to, when I was in running the businesses, we looked to rotate a box around 5.5 times a year. I suspect that's a lot lower than now. So to get that return on that container, you need to just work faster.
Thank you, Nigel. We'll just take a quick break. We'll be back with you in a moment. Is your company expanding into new markets in Southeast Asia and India? Well, why not let the experts manage all your logistics and regulatory requirements to achieve a smooth, compliant transition? Dimerco Express Group, connecting Asia with the world since 1971. Welcome back. This is Mike King, and I'm here with Nigel Pusey, the CEO of Container Trade Statistics. So, Nigel, China losing share into the US, but holding strong into Europe. The boxes are presumably going from China into somewhere else. I'm hinting. We've heard a lot about Sub-Saharan Africa and South and Central America as growth markets. What are the numbers?
Yeah, so Sub-Saharan Africa, as first quarter, is still up 33%, which is incredible volumes. I believe it's something like 1 million TEUs more extra into Sub-Saharan Africa than this time last year, which is quite something. Pretty much driven all out of China, largely to West Africa, though East Africa is catching up. So that's the very big one. Central South America is up 17%. And that's pretty much largely East Coast, Brazil's, etc. And then the other one, which is slightly hidden by what's going on in the Middle East, is India, is 17% up year on year. So we've got this constant, and this has been now going on since the Q3, Q4 24. And that's my point earlier, that before Trump was even in place, China had made a clearly conscious decision to start moving cargo and finding other markets because they were going to lose it out the volumes to the US. And this march into the southern regions has now continued now for pretty much 18 months. And I don't see it decreasing unless the oil price gets to the point where that it starts to affect the GDP increases in the Nigerias. So this is it's an investment led at its first level. It's a lot of investment coming in, but it's also an element of consumer demand as well. And that may tail off if the oil price continues to rise for the rest of the year.
That Sub-Saharan Africa up 33% really struck me. It just made me start thinking about quite a few other little other things that are going on economically. This feels to me like it's a long play for China, because they've been investing and building infrastructure right across Sub-Saharan Africa, or large swathes of it, for various reasons. Some of it's to get hold of resources, some of it's to build political capital, some of it's to make money on those investments. We've also seen, though, at the same time, massive investments in ports and logistics, just from European carriers as well as from China. Is that enabling these sorts of numbers, do you think?
Yes, I don't think it's don't think you'd achieve this volume growth in the likes of Lagos or Timor, or if you didn't see some significant improvement in port efficiency. I mean, you can load as many boxes off you like, but if you can't get them to their final destinations rapidly, any port congestion, as we've seen during COVID years, can happen quite rapidly. So I think we're definitely seeing a massive improvement in the quality of port terminals. We're seeing 20,000 TEU ships go into Lagos, and this is almost unheard of, even 5-6 years ago. So yes, you did need port efficiency, and largely because for instance, one of the big projects that we've been looking at is this railway in the Western Africa, which is, I think they call it the Great Belt Railway or whatever, that has had this massive import of Chinese machinery going in terms of building that infrastructure project. It's a UN-based project, but China's the major supplier of goods into it because they're the only ones with the sort of machinery capability at the price they can afford. So West Africa is having a massive logistics revolution, it seems to me, at the moment, and it's going to be fascinating we're starting to see exports come out the other side, which is a fascinating change. You've got lots of capacity going in there from the lines, which is driving the price index. I mean, I think the price of cargo out of West Africa is half what it was this time last year, and that's largely driven by lines going, gosh, we need to be into this market, suddenly getting a large amount of capacity in there, and price dropping to cope with that capacity increase.
Bigger ships, more capacity.
Yeah, no, exactly. So, and that's the way these trades work.
Yeah, I've seen that myself a little bit in East Africa. The new railway from Mombasa into Nairobi, and then there's roads right through Uganda, filling into the whole Rift Valley area. I mean, it's there's been a hangover there in terms of what people think about those Chinese investments and who's benefiting from them. But there's no doubt the infrastructure is massively improved, and that creates lots of business opportunities for import-export.
And again, there, Mombasa is a classic example of a port which probably didn't function. Everybody believed it could function well. It just needed somebody to come in and manage it, who had the experience. And and there are a lot of big international port companies moving into these areas. And Mombasa has had a massive value increase. We overshadowed by what's going on in West Africa, but East Africa has similar increases in the last years as well.
Well, if anyone wants to check out a feature I did last year on South Africa, the good, the bad, and the ANC, that really does dive into how port efficiency can benefit or hinder trade. I think you can probably see what's been going wrong in South Africa has been going right in West Africa. Just let's pivot there, Nigel, to South America. What's that trade picture looking like?
Yeah, it's again pretty robust, pretty much largely driven by China. But the South American economies generally have been quite robust. We've had some good exports out of there over the last few years. But again, this one's slightly, I believe, more consumer-led than perhaps the Sub-Saharan Africa as the India one. I think India and South America are consumer-driven, increase in GDPs, matching imports, cheaper imports from China and Southeast Asia, largely China. But we're seeing some, robust figures. As I said, 17%, I think, first quarter. I think that's pretty much what it was for this time. For the whole of last year, 25 over 24, we've seen something similar. So, yeah, very strong growth. And again, that's probably more vulnerable to oil price increases. If that continues, then I think that may be a much more vulnerable one than the Sub-Saharan.
Just on distance.
Yeah.
The EU-Mercosur agreement came into force 1st of May. Obviously, too early to see any change in trade, but do you think it'll drive things later, a few years down the road, maybe?
I think it will, but I think it'll be overshadowed by what's happening out of China, to be honest.
Maybe this is the market for Europe's failing exports.
Well, yeah, I think it's going to be a fascinating thing. It's a very exciting and interesting trade deal because it covers such a large area. But I think, at the end of it, it's going to be particular types of goods. We may not always see those coming over in containers, whereas I think the Chinese cargo will be largely consumer retail led rather than high tech.
Just a couple more, Nigel. The China to Middle East price index doubled in Q1 from 105 to 209.
Yeah.
Quite a jump.
Yeah.
I think we know why this might have happened. Volumes down 23.8% Q4 to Q1, and March alone down 62% year on year.
Yeah.
How do those numbers compare to what's happening outside of that region? Obviously, it's affected by war.
Yeah, so I think basically the whole region has suffered an import collapse, and that's partly because March was the month where people had to work out, well, above the Straits of Hormuz pretty much survives on container imports. So the economies need that for essentials, not just for sort of consumer goods. So there had to be some radical rethinking. So what we've seen there is people stopping, working out how we're going to reposition. I think the total region lost 840,000 TEUs in the month alone. So that was the 1.5% we lost in global growth, and that's the whole Middle East. 500,000 that is above the Hormuz, but it's also affected others because they had to think, well, how are we going to get that cargo? There was uncertainty. People didn't want their container suddenly stranded somewhere because they couldn't get into the Middle East, or people were bypassing it. But we've seen carriers responding to this and trying to find new ways in. And I think that meant everybody just stopped, took a step back, particularly from the cargo owner's perspective, thinking, right, let's not rush and put all our cargo to go there. Let's work out how we're going to get it there, step back, just keep the cargo on the quay, and then come up with a new plan. And I think that's what we've started seeing when we publish our data again at the end of next week. I think we're going to see a uptick in Middle East cargoes as everybody's starting to work out, right, what is it we're going to use as our new logistics plan into this region. And there are lots of fascinating ways how trade has found new ways of coming into the Hormuz area with their trade movements. So I think we're going to definitely see a tick up as people have come out of that uncertainty phase.
We've covered how the those air hubs and the carriers have recovered really remarkably quickly, considering there's still a lot of tensions out there.
Absolutely,
and missiles flying around.
Oh.
But I mean, you've just alluded to it there. We're seeing supply chains readjust and big winners on the port side, land bridges set up. Do you want to just walk me through that from your perspective?
No, there are a couple that are quite fascinating. One is some like areas like Khan, which is was a very sleepy port. Now it's become probably the most strategic one, just under Straits of Hormuz. And I was talking to somebody the other day, and they were saying they set up with a transport yard effectively for trucks was created in a couple of weeks out there just to start coping with the land bridge across through the mountains back up into Dubai and Abu Dhabi.
It's a good time to be in trucking.
It certainly is. I was saying something else. I definitely want to be a trucker in the Middle East.
Yeah.
And then the second one of those, which is probably the most lucrative, is cargo coming down into King Abdullah and Jeddah. We can't quite see it in all our data, but it's quite interesting that Al Daman, collapsed. But when you go into the detail, Jeddah and King Abdullah's seen an increase. Jeddah's actually got a slight increase, and I think we'll start seeing that more as we've seen the carriers start coming into Suez from the north and going to Jeddah and turning back and coming back out again, dropping the cargo off in Jeddah and then land bridging across Saudi. I've heard some very valuable rates to be the truck driver when you're driving across the desert to the likes of Qatar and Abu Dhabi at the moment. There's some very valuable incomes being there, but it's become quite a valuable land bridge for those countries, and quite a lot of cargo will be coming that way. It'll be fascinating to see how much when we release in the next couple of months.
Okay, thank you, Nigel. Let's do a bit of crystal balling to finish. 2 or 3 things you're watching for the rest of 2026. Now, you can't say Suez opening because I've been doing that story for so long now.
I'm personally a believer that Suez is going to take a long time before that happens. So I'm not even going to say it, but I personally don't think Suez will open much before the end of the year. People double their toes. I think there is a supply chain. There's a sort of equilibrium here at the moment that everybody's broadly happy with. It's gone much smoother than anybody expected. It's allowed supply chains to stretch a little. Okay, there's a higher inventory cost having them on the sea, but there is a certainty to that trade that people won't want to undermine unless it really, there's absolute guarantees. But to me, the big thing this year, and this is what's going to drive global growth if it continues at 3 or 4, above the 4%, is this continued drive in Sub-Saharan Africa and South America. And I think the big question for me is, will consumer demand be hit by the oil price? Has that gone on long enough? If there's peace in the Middle East, will oil prices come down? If they don't, and we have 6 months of oil prices high and it starts to affect consumer demand, I think we're going to see a drop off in latter part of Q3 and Q4. But if the growth in the container market will be in those areas, it's not going to be Transpac, and it will be less so in the European imports. So I think there'll be the key fascinations to watch as those southern trades start to gain in importance and volumes. The other one, which we don't talk about much, and I think this is a really strong trade at the moment, is intra-Asia. Intra-Asia, biggest trade globally. I think we hit 50 million TEUs out of 190 last year in intra-Asia alone. That is still incredibly strong, 7 or 8% year on year. First quarter, nothing dissimilar. And I think that will keep motoring. And again, will have some impact from an oil price, but it won't be so great as in Sub-Saharan Africa and East Coast South America.
Nigel Pusey, CEO of Container Trade Statistics. Thanks for joining me today on the Freight Buyers Club.
Good to be with you.
Much gratitude to Dimerco Express Group, specialists in global freight forwarding and Asia-US trade lanes, for supporting independent journalism. Thanks to Karen Ball and Tom Matthews for their production excellence. And a big shout out to you all for listening. I'm Mike King, this is the Freight Buyers Club, and we'll be back soon.